property has a different cycle to credit and to stocks and all that sort of stuff. So it's really interesting that we know what property does in a time like this. So I'm going to start with this chart of Sydney house prices going back to the 1970s, and this is up to 3 or 4 weeks ago. So this is up to the end of February 2020, and so it's extremely current. I know it kind of doesn't say it on the x-axis, but this is up to February 2020. And just a couple of key observations. And the first one is that property goes up over time. And when we're told this by our parents and grandparents that real estate is a very reliable wealth generator, very reliable asset, it's extremely true. And we try to overcomplicate things by timing the market and so on. But real estate's going up 80% of the time. Real estate does go up most of the time. And even though most of the time it's just inflation, funny money, it's still feeding into real estate prices first. So property does go up. That's the first thing. The second thing is look at the volatility since 2008. So real estate, had a random walk with an upward drift since the 70s, but since the 2008 crisis, the volatility has been huge. So every time there's been a very big correction downwards, there's been an equally sharp correction upwards. And so what isn't in this chart is that there's probably going to be a move down in real estate prices, but because zero interest rates creates so much A, inflation, and B, volatility, you would expect that real estate prices are going to spring up just as quickly as it went down. So there's a lot of volatility in the market, which is unusual for real estate, but it snaps back very, very quickly. So the snapback is really important to know, and you don't want to be investing after it's snapped back, because a lot of people in the 2017 to 2019 correction thought real estate would go down for the next 10 years. Real estate doesn't go down for 10 years, and we'll go into why that is in a moment. But Sydney property prices, with the crashes, the big stock market crashes, the generational crashes plotted on this chart. So the first one was in 1987 when the US markets and global markets dropped by 25% in one day. If you can imagine that, it shook the world. It was a big crash, and real estate went up. It actually went up quite sharply in that time. The dot-com crash in 2001, real estate went up very aggressively. And in 2008, real estate went down initially, and then it went on a tear. So the big stock market crashes either lead to real estate prices, generally speaking, going up. Although this is history, and you never know what's going to happen in the future. There's a couple of reasons why this happens. The first reason is that there's no panic selling in real estate. It's just not liquid enough. So when the stock market crashes, people aren't panic selling their real estate. On the contrary, they're hanging on to it. So there's no panic selling in real estate. And there's an old saying that in sort of times of volatility, you don't sell what you have, you sell what you can. So you're not going to sell your real estate. It's just not liquid enough. Okay, the second thing is, by the time the dust has settled on the stock market crash, the stimulus is in the system. So if it takes you, say, 2 months to sell a property, within 2 months after the stock market's crashed, interest rates are lower after these big crashes, the funny money via stimulus is in the system, and real estate investors who haven't panic sold because it's not liquid enough know now that there's all these tailwinds behind the real estate. So real estate catches the stimulus, but it doesn't catch the panic, if that makes any sense. So right now there's a disruption in the economy, and what I think will probably happen is properties that are on the market right now are going to go down in value. Everything else is, but apart from that, supply is just going to dry up. So the big disruption in real estate is going to be that there's nothing to buy. There's going to be nothing to buy. So the size of the property market is going to collapse, but that doesn't mean that property prices are going to collapse. It just means that there's no volume. You won't be able to find any properties because no one's going to sell. Everyone's going to wait. That's what's probably going to happen. That said, there are deals on right now. because people who have committed to selling realize they can't get their price anymore. So that's kind of the thesis for why real estate prices typically go up. But there's a problem in the analysis. The problem in the analysis is that we're using dollars to measure Sydney property prices. We're trying to compare a $2020 to a $1979. And the problem with that is that they're not measuring the same thing. A $2020 is worth a lot less than a $1979. We've had, well, we're in our fourth round of quantitative easing. Interest rates have been zero for about 20 years now, or a little bit less. So real estate prices go up, as we mentioned before, but they're not really going up in real terms. They're going up in nominal terms because nothing goes up forever. If a house always went up in value, eventually one house would buy the world. And that's not what's happening. Most of what we think is savvy real estate investing is actually just inflation. And the reason we know this is because if I was to put a chart of bread prices since 1979, or movie ticket prices, or something like that, whatever, pick your good, or the Dow Jones, or anything like that, it would look like this chart, because prices go up over time because of inflation. And every time that there's a disruption, they inflate more by lowering interest rates. So how do we know what's really happening in the real estate market? Well, you have to measure stuff with stuff. So you could measure the price of real estate priced in bushels of wheat or barrels of oil, or I don't know, whatever. Pick your, but if you're measuring in dollars that can come off the printing press, you're always going to see charts that go up. So you need to measure real estate in other things that can't be printed. And the thing that is usually done to measure the value of things over long periods of time is gold. So the asset, like gold is money, and the reason gold pans across the Bloomberg screen at the bottom of the TV is because the monetary anchor for Australians, we're comparing our dollar against US dollars. That's our monetary anchor. But the US dollar is being compared to gold. And so the reason gold is on the Bloomberg screen is not because anyone wants to find out what the value of jewelry is. It's because they want to know what the value of the US dollar is. So gold's money. That's the point here. If we price real estate in gold, it tells a very different story. What it shows us is that since the real estate in Sydney actually peaked in 2004, and it's been in a bear market ever since. It dipped and hit a low in 2008, and again in 2010, and we're back right now at our 2008 lows in real property prices. Let me illustrate, right? So between 2012 and 2016, right? That's the recent surge in property prices that everyone remembers, 2012 to 2016. Property prices in Sydney went up by about 40%. At the same time, the dollar, our money, went down by 40%. So the Aussie dollar crashed and Sydney real estate prices went up. But in real prices, Sydney real estate just went sideways because what we're measuring the property with collapsed. So gold neutralizes all that noise from currencies going up and down. And what we can see is that real estate, as I said, it's actually at its 2008 levels right now. Now, the reason this is important is if we're going into a property market correction, potentially, or we're certainly going into an economic disruption, we're not going into an economic disruption with kind of the same asset bubble that, say, the Dow Jones is. So there are asset bubbles out there, and Sydney property prices aren't one of those asset bubbles. We're actually at very, very like long-term average prices. Doesn't mean it can't go down, but if real estate prices in real terms are at 2008 levels, that means there's not that much downside. It could go down, but we're not talking about these bubbles that we're seeing in, say, stock prices. Real estate's not in the same sort of bubble. And that's what I wanted to convey. The other reason for that is we go into what is a period of great disruption, but we took our medicine in the property market 2 years ago. So in 2017 to 2019, the real estate market went down significantly. So in a sense, because of that, we don't go into this in a bubble. we go into it having come off a major correction since 2017.